Hey there friends, and welcome on back to Finance with Frittles. If you're new to our channel here, consider hitting that red subscribe button. If you like the video, give us a thumbs up, and if not, give us a thumbs down. So today's topic, all about bonds. Bonds. Okay, so bonds are pretty straightforward. They're not that difficult. Here's how they work. They're just a debt instrument. So I give you money, and at some point down the road, you have to give me that money back. And during that whole time period, you have to give me interest payments along the way. It's a de facto IOU.
That's as good as money, sir. Those are IOUs.
So let's take an example. You see, for most companies, they oftentimes want more cash than what's currently on hand. They want to invest in their company, buying more property or machinery and equipment to produce and deliver more goods and more services. More goods and services in turn means that more revenue will flow through to the earnings and improve the company's overall profits. But here's the thing, companies don't just need cash to invest in their company through capital expenditures. They also need cash to pay their employees. They need cash to pay vendors for inventory. But they also need cash to return value to shareholders in the form of dividends and stock buybacks. So the ultimate question becomes, how does a company such as this one actually get the additional cash that it wants that it doesn't have from its own operations? Well, one of the least expensive methods is to simply borrow that money. You see, there's a plethora of people and organizations that would willingly purchase debt instruments from the company. They say, hey, I've looked at the financial statements of this company, it's doing well, and I think it's a good investment. I tell you what, I'll lend my money to the company today. And in exchange, the company will give me interest payments every 6 months in the form of coupon payments. And at the end of the term, when the debt matures, the company will also give me all my money back.
All right, so this term here that we refer to as matures, or when the debt instrument reaches maturity, that refers to the duration over which those interest payments or the coupon payments are paid to the lender before the face value is paid back to the lender. So for example, if you were to take a 5-year corporate bond, then for a period of 5 years, usually in 6-month intervals, interest payments or coupon payments would be paid out to the lender over that time period until the 5th year, at which point the face value would be paid back to the lender. Same thing for a 10-year corporate bond. In that case, you'd have a 10-year period, and again, usually in 6-month intervals, you'd have interest payments or coupon payments that would be paid every 6 months until the 10th year, at which point that face value would, again, in that case, be paid back to the lender. Now, you might have a question about this term face value. What does this term face value refer to? Well, the face value is what's actually paid back to the lender when the bond matures. Now, most corporate bonds have a face value of $1,000. So, for example, if you were to take a bond with a face value of $1,000 and it's priced at par, then I would have to pay $1,000 to purchase that bond. I'd have to fork over $1,000 to get that bond. But when the bond matures, I would get back that $1,000, and on top of that, I would receive those aforementioned interest payments or those coupon payments every 6 months until the bond reaches maturity. So it's a good way to fork over your money to a company. The company has to give you that money back, and on top of that, you receive interest payments, again, usually in 6-month intervals until the bond reaches maturity. So in this exchange where people and organizations actually purchase debt from companies, and what kind of debt instrument does this contractual obligation actually exist?
Well, the corporate bond, of course. Corporate bonds are often sold in a variety of maturities, including 3-year, 5-year, 10-year, 20-year, and even 30-year maturities. And the issuance of these bonds is done on what's called the primary market.
Now, an investment bank usually creates these marketable securities, these corporate bonds, and sells or floats these corporate bonds on the primary market. But once primary market selling is complete, then the bonds now trade on the secondary market over exchanges like the New York Stock Exchange. Now, once trading on the secondary market, large institutional investors like Vanguard or BlackRock or Goldman Sachs and retail investors like you or me can buy and sell these securities or these corporate bonds on the secondary market.
Okay, but now comes the real interesting part. Bonds that trade on the secondary market have many buyers and sellers in what's called a bond market. And in fact, most bonds might sell, and they often do sell, for more or less than their face value. A company might place a bond on the market that has a higher coupon rate than the prevailing market rate for bonds in its class. Therefore, people will line up and really want to purchase that bond because it has a higher return in the form of a higher coupon rate than most other bonds of its kind on the market. The demand is high. However, there's only so many bonds issued by the company, and the limited supply means that these competing buyers will actually bid up the price of the bond. In the end, these bonds will sell for more than their face value, therefore selling at a premium. The opposite can happen for lower priced bonds, which actually might sell at a discount.
But wait, there's even more to corporate bonds. Not only is the demand for a corporate bond a function of its coupon yield, or those coupon payments that you receive in those 6-month intervals, the demand for a corporate bond is also a function of the risk that the company might not actually pay all of its interest payments or might not pay the face value when the bond matures. Now, when a company fails to meet a coupon payment and misses a coupon payment, the bond enters what's called default. And companies with poor financials have a much higher probability of default. And therefore, they're going to have to actually entice investors or entice purchasers of its bond with higher yields. So you will see yields to maturities on a bond of a company with poor financials be much, much, much higher than the same type of a bond with a company that has very good financials. Now, there's a multitude of ways to look at the financial strength of a company. You can look at the balance sheet and compare its assets to its liabilities. You can see how much liquidity it's got with its cash and cash equivalents on hand to be able to continue to service its debt. You can look at a number of things. Cash flow statement. You can look at the operating activities and see just how much cash those operating activities provide compared to how much cash the investing and the financing activities actually soak up. But what's really interesting is one of the best metrics to look at a company's financial strength and its ability to service its debt is to look at the historical record on the income statement of what we call the interest coverage ratio. Now, this is a pretty simple metric. We simply take the pre-tax operating earnings, or EBIT, this is commonly referred to as earnings before interest and taxes, and we divide that figure by the actual interest payments to get the interest coverage ratio.
For example, Microsoft is an extraordinarily financially strong company. It's a veritable cash cow. In its 2018 10K, its pre-tax operating earnings of almost $43 billion was 16 times its interest payments. In other words, it could pay for its interest payments 16 times over before running its EBIT dry. Therefore, its interest coverage ratio is 16. However, a company like Frontier Communications is not in good financial straits. Its pre-tax operating earnings aren't even enough to cover its interest payments. There's a strong probability of default here. As a result, Frontier has a bond that matures 2 years from now that's priced to yield to maturity about 42%, while a bond from Microsoft that matures in 2 years yields just 1.78%, a stark difference reflected in the market's perception and the probability of default between the two companies.
But companies aren't the only organizations to issue bonds. You know the biggest supplier of bonds? Uncle Sam, the United States government. The U.S. government, when it issues bonds, these are called Treasury securities.
In this case, the government, through the Federal Reserve, replaces the company from our earlier example and issues fixed income securities to the public through a primary auction. These securities are in turn traded on the secondary market. Now, Treasury securities are not just termed bonds. The shortest maturities of a year or less are called Treasury bills and are often referred to as T-bills. Again, they have a maturity less than 1 year. The second category of Treasury securities are termed Treasury notes and maintain maturities anywhere from 2 to 10 years. The third category is the Treasury bond. These have maturities greater than 10 years all the way up to 30 years.
Now, don't get the maturity of a Treasury bond somewhere in the neighborhood of 10 to 30 years mixed up with corporate bonds, which can have shorter maturities, like 3 years or 5 years or 7 years. But the final class of domestic bonds is what's called the municipal bond. Now, in this case, the company or the federal government that we had in our earlier examples, that's replaced with state or local governments. And in this case, you can oftentimes have some pretty considerable tax advantages with these municipal bonds. Also, they come with face values that are not so commonly at $1,000, but can be at different denominations like $5,000. Anyway, that's a very simple coverage of the bond at a 30,000-foot view. But in our next video, we'll cover the yield to maturity on a bond and the calculation of a price to see if a bond might be properly priced. Thanks for watching Finance with Frittles.